regulation side, which is the government. Importantly to know that in the mining industry, the most minerals are desired for their properties in use and not for their intrinsic value. That is to say that their demand is derived. So nobody goes and mine copper because they want a lump of copper on their table. It's actually because they want the properties that a proper copper would bring to whatever they want to manufacture. I mean, this is not for all commodities. Gold, for example, is a store of value, so it is actually mined for its intrinsic value, similar to precious stones. But in overall, most commodities are actually having a derived demand. There is a persistent interaction in the industry between the industry, the investors, and the regulators, and most of these features around gaining benefits from the project. From the government side, they would want to gain the highest possible tax base, whereas for the investor side, they would want the highest possible return on their investment. So it's both parties want something from the project. Now I've put a graph there from the mineral intensity of the Clean Energy Transition Report from the World Bank, which came out this year, and it just shows you how the transition to clean energy is going to be mineral intensive. And this really speaks to the need and the importance of mining and how mining is going to be very important going forward. And if you look at, let me just get my laser. And if you look, for example, at the demand for graphite, transitioning into this, into a clean energy environment would require, by 2015, the demand would be 500% of the demand of 2018 production. So you can see quite a large derived demand because of these commodities and how they will be used in transitioning to the clean energy. When we look, so I'll start with the first characteristic that I've put here is that mining is very location specific. The activity of mining is controlled by geology and not by the business environment. And geological speaking, there's only certain areas and certain geological settings where you can find certain commodities. And so mining can only occur where those commodities are geologically feasible to occur. And for example, when you look at this map, this is just some of the distribution of mines, deposit, and critical minerals in the world. For example, if you're going to look for platinum, you'd do very well to go to South Africa or Finland or even Canada. But if you were looking for rare earths, you don't go to North or Central Africa because the mineral potential has not been delimited, or certainly the current existing deposits don't show feasibility there. Certainly there is a need for more exploration and more delineation of mineral potential, and these will come up as we have a discussion of why that is so. But again, the mining will then only take place where there is mineral occurrence, and that mineral occurrence has to meet criteria and that it has to be economic. And so this is very much contrary to other economic sectors and economic activity where geology is the determinant of the activity. Additionally, you can see that the geographic distribution is not even. So commodities and occurrences and deposits don't occur everywhere. When you look at the geographic spread, in terms of the producing countries and the consuming countries, you will see also that those are quite different. Like as I mentioned, the commodity mining, the demand for commodities is a derived commodity. And this is usually pushed by industrialization and development. So you will see that industrializing and developing countries would be net consumers and would consume a lot of the production. But you'd also see, interestingly, is that most of the production is actually coming from the least developed countries, or at least those are not, whose development is not very fast paced. For example, with the copper production, you will see that geographically, Chile and Peru are producing, are the top 10 producers, well, at the top 2 producers of copper, whereas the consumption of copper is mainly in Asia, and 51% of it is actually China. And China is developing at very fast pace, and the industrialization pace is very fast, and they just consuming, they need that material. Again, I've put an example of cobalt there. 64% of cobalt production, global cobalt production in 2018 came from DRC, but nearly 98% of that is consumed in China. Again, speaks to certainly the need for cobalt in technologies in China. Now, because the activity is very location specific, it's highly impacted by government action, and therefore political and social risk is quite high. So in terms of investors, they would like to know what the risks are. So the political risks, is there a risk of unrest, political unrest? Is there a risk of appropriation? So nationalization, is there a talk? So those are the kind of factors that the investors would look for. Importantly to note, the producing countries or countries with these deposits, technically speaking, because they have a location-specific deposit that cannot be moved, they should be having some sort of advantage in terms of what they can gain from the projects in their geographic locations. However, this is not so, and this is because the mining projects are quite capital intensive and large investments are needed. And the players that have that, the capital to actually make those investments are quite limited. Countries, therefore, have to take part, well, they do take part in what is termed investment competition. So countries want to give the best terms they can, or the most favorable terms they can to attract this investment. I mean, it's a counterintuitive action, and it has not served developing countries and certain producing developing countries in much stead in this action, because essentially this the product is immovable, and you should be able to leverage that. I mean, it's not similar to if you want to build a factory for bicycles, for example. You have a choice of where you can build it. But if you have a gold deposit in Namibia, it's in Namibia. You cannot move it elsewhere to conduct that business. The next characteristic I'm going to talk about is the complex market structures and the configurations. And this, first we'll start at the industry players. There are quite diverse industry players in the mining industry. And we're starting with the artisanal and small scale mining. And these are usually quite informal and don't have a legal status in most countries, although this is coming up more and more to how critical they are in terms of a supply of minerals to the global demand. And just looking at the supply chain, for example, in the supply of gold from artisanal small scale mining, that makes up about 20% of global production. So these are quite, although having not been recognized, they play a major part into the global supply of commodities. Artisanal small scale miners are usually quite small sized, very much labor intensive. The industry employs about 40 million people directly worldwide. So it's quite a large employer, particularly in areas where near surface, easy to mine deposits are found. So your gold, your sapphires, your diamonds, your alluvial diamonds. And it's very much low and semi-mechanized, so rudimentary mining. Large-scale mining, on the other hand, and the players that take part into it are very much capital-intensive and highly mechanized. they tend to focus on deposits that have different complexities depending on where they are. And they are not, in terms of benefits of large-scale mining, employment is not a major ticket for large-scale mining projects. In terms of land use, they tend to occupy quite large sizes from exploration through to production, but also not only in terms of the footprint of the activity itself, but also in terms of the infrastructure that's needed to get the product out of the ground. And certainly in terms of, from the regulatory point of view, there's been a lot of focus in ensuring that revenue and benefits from the large-scale mining are captured as opposed to the informal sector. And this has obviously brought up quite a number of problems, one of which is, for example, the DRC produces a significant amount of copper or of cobalt to production per year. And about 20% of that is actually from small-scale mining. So you will see that there are opportunities for revenue leakages when regulators do not recognize artisanal small-scale mining activities. Another player in the industry are the junior companies, and these tend to have lower access to capital, and therefore they do not normally take part into project development. They are more on the exploration side and the focus on finding the deposits to sell and hand over to the large-scale miners. Their focus is on short-term profitability. So they go in, they explore, they find the deposit and sell it off, where as compared to the large-scale miners, they're more into long-term profitability. Junior companies are very much the life force of the mining industry. And this is because a large percentages of the discoveries are actually accounted to them. When you look at this graph of according to number of discoveries based on the players, you'll see that junior companies have always accounted for the larger portion of discoveries. And this really speaks to the life force of the industry. Without discoveries, the industry cannot go on because eventually the existing deposits will be depleted. And then quite a hot topic usually is state participation. How is the state actually a player in this industry? And we tend to think of the state as a player in terms of the revenue that they would capture, but there are different forms in which that revenue is actually captured. We tend to think of taxes and royalties, but the state can actually participate in what is called a production sharing contract, where the government and the contractor actually agree to share the extracted resource. And in this case, usually the contractor will bear all the risks and the cost of exploration, and they will then share they will find some sort of agreement to recoup that risk and their investment. Then there are service contracts where essentially the government says, this is our resource, we are looking for someone to extract it for us, we'll pay you to do it, and everything else is on us. And then something that resurfaces quite often is nationalization. And this speaks to host countries and producing countries' needs, and certainly the citizens' desire to have some sort of ownership of the resource. This is quite a controversial or a hot topic, depending on where you stand. But it comes with inherent risks and certainly hurdles for regulators to overcome. One of the hurdles is the cash part of the industry, where the industry is very much capital intensive and large amounts of investments are needed, certainly at the onset before you have positive cash flows. And the problem is usually that domestic banks and capital markets are not developed to have this kind, to fund this kind of projects, and probably don't have the capacity. And there's a lack of technological and managerial experience to really bring these two projects into fruition. And of course, the answer would be there's a lack because we haven't done it before. And if we do it, perhaps we will learn and know it. So it's a case of who wants to go first. And certainly nationalization has been tried in different countries, but it always seems to bring specific responses and specific issues arise. One of the issues is a commercial efficiency when there is no competition. Assuming a host country decides that they would want to run the industry themselves with no competition, are governments actually suited for this kind of commercial activities? And then that's always the question to answer. And then there is a question of cash flow. Where would this funding come from? Governments are suited or are there to take care of the needs of the society, and therefore government budgets would always have competing demands. So there will be the social aspects of it, the infrastructure, the healthcare systems, and so on, as opposed to competing with a demand for injection of funds for investments, for exploration investment, for example. Experiences with nationalization have shown that host countries tend to deviate from the commercial aspects and the commercial parts of the business to non-commercial objectives. And this is probably right, that the national affinity of the government would be to deviate from the non-commercial aspects, because they would be focusing on job creation, local capacity building, social infrastructures, so building roads and building hospitals and schools, as opposed to actually working on the commercial side of the national company or the national mining company. And this, obviously, if you are in a commercial activity and you are not actually following the commercial rule of law, you would not be a viable commercial entity. And this is unfortunately what normally happens. There's also a question of conflict of interest. Who polices the police? If the governments, who are also the regulators, are taking part in the commercial aspect, is it going to be a fair competition? And are they going to ensure that they stick to the letter of the law in terms of the regulations, for example, environmental, social corporate responsibilities, rehabilitation? Are they going to stick to the letter of the law? And how does the industry ensure that they are being treated fairly? Certainly in terms of availability of resources, geological information that should be supplied by the government, will this be shared on an equal basis? Will this be available to all, or will it be a slanted sector? The government role in most of the nationalization in countries that have nationalized is that there's always been a problem, or the sticking point is the transparency and governance of not only the company itself, but also the revenue generated. There seems to be always weak commercial structures. There's no incentive to operate on a commercial level, and there's lack of governance and transparency. Evidence has actually shown that in most cases where governments have national mining companies working in the same sphere, so there's competition between the national mining companies and the industry, a government is able to recoup more from tax revenue than they actually recoup from the state equity by participation of the company. So there is always that debate of how is government faring with this type of, with nationalization. Interestingly enough, when you look at the setting up of fiscal regime, you can set up production sharing and service contracts and tax and royalty systems in such a way that they are equivalent to equity participation, state equity participation. And it's probably those kind of avenues that governments and citizens who want to have some sort of ownership should pursue. So back to the complex market structures in the mining industry. What complicates the mining industry is that there is also, because of the variety of commodities, there tends to be no clear boundary within the industry. And this is to say, this is, for example, with oil is a mineral, but it usually does not fall under the jurisdiction or the description of mining activity. It's termed, it's almost put aside in a different sector. Again, bulk constructing material, the material with low value per ton, these are also usually removed in the considerations of the mining industry. Another complexity in the structure is the boundaries between mining and the processing that follows. And I've put there the mining value chain, where you have deposit will have to go through exploration. So finding the deposit, once it's economic, you start developing it, so building your infrastructure. Then you actually extract and process the ore. Extraction and processing might actually be two different categories. Then you have the logistics and trading part of it. So how do you sell it? Where do you sell it? Who do you sell it to? How do you price it? Then there is the refining of it to create fabricated articles. The boundaries usually between the extraction side and the logistics and the fabricated, certainly the fabricated side, is sometimes fuzzy. Where do you draw the line of value addition versus raw product extraction? And that, and I'll give you an example of why that complicates things. In terms of configurations, the mining industry, certainly in the large scale, for large scale miners, mining companies, most of these are multinationals. And there is a tendency sometimes for multinationals to vertically integrate. And this is to say that they would then try to align their businesses to cover the whole value chain. So they would not only be taking part in the exploration and the development and extraction, but they would also be at the other end, where they would manufacture the fabricated articles or the finished product. And there are certain reasons why they do so. Part of it is to reduce the risks in terms of demand and supply of the commodity. So if a company has control of the production side, they are able to, and production and the manufacturing side, they are able to actually align the production with that demand on this side. So the supply on this side with the demand on this side. And that's to ensure basically equilibrium or to control pricing. Price control in this aspect really only works if that producer or that investor or the company has a dominant market supply of that commodity. If not, that would not necessarily give them an advantage. For certain companies, for example, the news has come out that Tesla has secured rights to mine lithium, and that was in September this year. And that's really because they've noticed that they are at this end where they need lithium batteries, but because of the technological, how do you say, limits, the technological limits in lithium extraction and rare earths like extraction, and certainly the incentives they basically control the demand for it. So there is no incentive for most players to enter the market here for exploration and development. They themselves then enter in to create the supply to meet the demand that they have. And this would work for Tesla because they know exactly how much it is that they will want, and then they can and enter the market and create it. But this vertical integration means that multinational companies, mining companies, are some of the largest companies in the world. And that gives them certain powers that smaller companies might not have. In terms of the complexity of the market structures, the fuzziness of where extraction and where processing starts somehow complicates fiscal regimes, but also brings in certainly issues in terms of overall revenue collection for the regulators. When you look at the Namibian fiscal regime, for example, the Namibian fiscal law, the mining companies will be subjected to a tax of 37.5 to 55%. Those who are on the downstream part and are registered as manufacturers would be subjected to 32% to 32 to 18% tax. Now, for the mining industry itself, in terms of governments wanting to ensure that they capture all revenues in the value chain, they tend to try to attract investments in manufacturing. And what Namibia had done is set up an EPZ zone. And this is a tax-based incentive where essentially any company that is registered under that regime pays no tax. Now, how does this impact the behavior of the investor? Any investor who has a vertically integrated business is then, I'm trying to say, not to say he's forced, but the behavior, there is an incentive to act in a certain way. And that is to push profits into a lower jurisdiction. And certainly in terms of behavior, there will be loss of revenue overall from the tax base here, which will be diminished because there's an incentive for them to declare lower profits here, or certainly to sell the ore to a related facility at a lower price, which means that revenue here or profits here are lower. And therefore the tax base is lower. Once the product has entered this, this jurisdiction, certainly if they have EPZ status, there's a total loss of revenue. And so there's the behavioral cost in that there would be an incentive to push or shift profits. And then there is the direct cost in terms of you totally lose the revenue because you don't consider it taxable, or you've given some sort of incentive. Hence, the complexity in fiscal regimes and in trying to gain maximum revenue from mining projects for the regulator. A very prominent feature of the mining industry is that there is inescapable uncertainty. There's just uncertainty that is inherent and cannot be diversified away. And this is in terms of exploration and geological uncertainty. Exploration itself is quite risky. The chances of an exploration project coming to stream and becoming a mine are very low. Only 1 out of 300 to 500 projects actually becomes or targets become a mine. So there's that uncertainty of when you invest in this activity, there's a lot of uncertainty in terms of success. There's also geological uncertainties in terms of knowing the exact ore grade and quantity. And these are only known to a certainty when production starts. So exploration itself will not tell you to a certainty. They will tell you to, there's a lot of extrapolation in terms, you cannot basically drill the whole deposit to find out exact. This will only come out when mining commences. In terms of exploration expenditure, certainly I've put a graph there that shows exploration expenditure compared to discoveries. And certainly in the past 10 years or so, there's been a tendency of exploration expenditure, high exploration expenditure with low discoveries. And this is a feature, and this talks to really the fact that many of the easy to find deposits are probably and most certainly already found. So exploration is becoming more and more expensive, targeting deeper lying deposits. And so there is a lot of technological advancement and a lot of expenditure that needs to go into finding new deposits. Now, this uncertainty, especially exploration geological uncertainty, might not pose such a huge risk for diversified companies. So companies that have a lot of fingers in the pies will be able to diversify that risk away. However, the host countries where these deposits occur are not able to diversify, are usually not able to diversify that risk. And so for a country like Namibia, for example, which depends on mining revenue, and most of that comes from the diamond sector, we are unable to diversify, we are unable to cover that risk in any other way. So it brings a lot of exposure to the jurisdictions where these deposits are. Certainly for the investors, unknown geological factors contribute to uncertain operating costs. And this speaks to the next point, which is that there is uncertainty in terms of prices. So not only do you have uncertainty in terms of costs, because you don't know your grade, you don't know your exact metallurgical properties and the technological needs that would be needed to liberate and the costs that will be needed to liberate your commodity. You also have uncertainty in terms of what you're going to be able to gain when you want to sell that commodity. In the short run, the prices are quite volatile. Again, very much dependent on the consumption, demand in consumption, and industrial activities. For example, when you look at the curves of zinc, gold, and lead from September 2019 to August 2020, you'll see the huge impact of COVID-19 in terms of the prices. Certainly for commodities like gold, which are store of value, investors would tend to run to them because they are more certain in terms of returns. But for other commodities, the revenue dips and certainly the revenue booms as well play an important part in overall ability to recoup investment from the project. And this is quite a significant characteristic of the mining industry in that it is characterized by boom and bust. And usually there are quite high fixed costs in the mining industry, and marginal mines are very much impacted by this boom and busts. Overall, if a project is 20 years and you have this cyclical nature of up and down commodity prices, your net rents from that project, that is your cost plus your revenue plus all other factors in terms of returns on investment put together, your net rents from the project might actually be negative. And that's just because of the volatility and the cyclical nature of the prices. From the regulator's point of view, if you are unable to plan or to know what what profits that business activity is going to bring, you are unable to plan on them properly. So you have planning based on uncertain revenues. So a country might very well have a deposit, and the government has a certain price, or certainly the investor has a certain price to what to expect in terms of profits and revenue, and the tax base for the government. But that is not an actuality, because it's all dependent on the cyclical nature of the prices. The price booms and busts also negatively impact investment and production decisions. That is investors would need to think carefully about which commodity they enter and how they enter and when they enter into it. And for production, for those who are already in production, stopping is not just a click of the button. It's a lot of factors to contend with, to make the production decisions of whether you should stop because you are totally running at a loss or not. But responses to the boom and busts in terms of behaviors of the investor and the regulator. For boom times, the regulator tends to want to renegotiate terms in terms of revenue recoupment. So you would have talks of windfall taxes because the mining industry is making extra profit because the prices have just gone up. For the regulator and for host countries, this is usually a time where they have also access to credit, because they are able to somehow plan on this forecasted extra revenue based on current prices. And this is obviously not an ideal situation. So it makes it's a critical point where regulators plan on uncertain revenues, and that planning includes major expenditures. But when this revenue does not realize, we have projects that need to be paid for, and there's no money in the bank. And for many resource-dependent countries, this is a major problem. And essentially, it is the problem that governments tend to treat mining revenue as income rather than as capital, because mining revenue is actually an income, and it should be invested to produce more revenue, or to produce some sort of fixed income into an investment. So it's actually capital for investment. It's not income for consumption. When during the bust periods, when commodity prices have dropped, usually it's on the side of the industry who then comes to the regulator and says, we need a tax break, we can't function, we need leeway to be able to survive. So this uncertainty brings about an uncertainty in terms of interaction between the parties. One would always want to negotiate because of the prices and the position they've been put into by the prices. In the long run, commodity prices have shown that there is a decline over the long term. And this means that producers will need to compensate for losses in unit values by stepping up production. This just means that it's becoming more and more expensive to produce at the same rate. So for you to, or certainly to gain revenue, so for you to earn more revenue, you'll have to step up your production. And this is not always feasible. There's always capacity restraints in terms of production capacity for mines. So there's always so much they can do. After that constraint, they will have to step up and do major investments to increase the production. Another feature of the industry is that it's characterized by high sunk costs and long production periods. And I've been talking about exploration investment and how it is quite capital intensive. But exploration is the life force of the industry. And it speaks to the need to create value. Exploration creates new mines. It replaces depletion by existing production. And it replaces reserves that are made uneconomic by the modifying factors. So any changes in the modifying factors that render deposits uneconomic, then those reserves need to be replaced somehow. Here we have a graph showing exploration expenditure in Namibia from 1995 to 2018. And you will see that it's quite substantial. That's million Namibian dollars. That's 850 million Namibian dollars. That was the peak of exploration. In overall, global exploration peaked in 2012 and has been declining ever since. But it's the sheer numbers and the sheer capital that is involved without any expectation of positive cash flow. This is all sunk costs. There is no guarantee of recoupment, and certainly when investors and exploration companies sink money into it, it's not to use that money as a decision making for further investment. It's simply to sink the costs and hope for the best, basically. So there is a lot of need to create value in the industry, and that costs a lot of money. Now, the industry itself, when you look at a single project in terms of exploration and then up to decommissioning, this whole period can take up to 20 years, certainly, but certainly up to 100 years. I mean, Namdeb, for example, has been mining diamonds for the past 100 years. So the projects can be quite long life projects. And you have large costs at the onset of the project, which is the exploration. And once you've found something feasible, it's the construction phase where you bring through, you build your infrastructure, which can include roads and sometimes can include hospitals and schools in remote areas. So quite a lot of large negative cash flows before any positive cash flow is seen. And additionally, a lot of the costs during production are fixed, so they cannot be changed. It's costs that will have to be incurred, whether there's a change in production or not. Now, this brings about a time consistency problem. During the initial onset of the project, an investor would look at the existing fiscal regime and decide whether it's viable or it's feasible or it fits their risk appetite to invest in that country. In response, the regulators and the governments would generally give very favorable terms because investment, exploration expenditure spending it's good investment overall for the country where exploration is taking place. And certainly when there is a mine found, or an economic deposit found, the benefits to the host countries increase. So regulators would like to give favorable terms and they will negotiate very, very well. Once the project starts having positive cash flow, then the regulators will be, wait. Did we negotiate well? So they will start thinking about renegotiating the terms so that they can capture some more of this positive cash flow. And this is really brought about because at the onset, There is uncertainty regarding the cash flows, and decisions are made here with uncertain outlook in mind. So these decisions might not necessarily be made in favorable conditions, for lack of a better word. But a forward-looking investor for a jurisdiction that constantly wants to renegotiate the terms would then think that's not the jurisdiction that they would want to enter into. So the response from investment is that they would hold back into entering that jurisdiction, and the less exploration that occurs, the less deposits are found, and the less chances of finding deposits exist. And so it brings up a cycle where, although regulators want to capture the rents here or the tax here, their decision, their initial decision is actually shooting them in the foot. And I mean, it's usually cases like that where talks of nationalization and appropriation comes in. So it does not make for a very stable mining and investment environment. And I mean, it's just to point out that the decision to renegotiate terms here is not necessarily done in bad faith. It's done because the time in which the decision was made, the positive cash flows, the actual benefits have not already exhibited or come through. Now, looking at all the uncertainties that we've discussed, the pricing, the geological, certainly political uncertainties, this makes mining quite high risk. But those risks come with very good potential high returns as well. And in terms for the host countries, the tax revenue can be so substantial that they can dominate the economic activity in the host country. The mining contribution index of 2016 numbers show that a lot of developing countries are quite dependent on mining, and it's a substantial portion of the economic activity of the country or of those countries. For example, in 2017, the DRC, 17.4% of GDP was from mining, and 86% of the total exports were mining exports, and certainly revenue, 55% of the total revenue. And I mean, it's not very different from Namibia, which is largely dependent on mining revenue to stay afloat. 54% of total exports in Namibia are mining related exports. And so the potential returns for the host countries is quite high. And there is therefore an incentive from the host country to ensure that they attract as much investment into mining as possible. The returns for the companies and the players in the industries are also quite high. When you look at the ranking of the top 10 mining companies by revenue in 2020, you will see that Glencore revenue is $250 billion US. And I mean, this surpasses the revenue of some of the countries, or certainly the revenue of Namibia. So you can see that and as much as they are very high risk, they're also very much high return. It's also very much a high return industry. One of the complexities, and it's almost similar to the time inconsistency problem, is the information asymmetries that are prevalent in the industry. You have multinationals who are commercially, for lack of a better word, commercially savvy, who therefore have a lot of information at their disposal, compared to the regulator. And this is in terms of geological information, geological know-how. This is in terms of the commercial attributes or at each stage. Certainly vertical integrated companies would know a lot more about their value chain and the commercial and profitability at each stage compared to the regulator. And then in terms of acquiring information about reserves. So there is an information slant where one party is coming to the table with a lot more information than the other. Of course, this means that decision-making is not necessarily, it's not an equal environment of decision-making. From the investor's point of view, for example, if they have a deposit, they are very much, they could understate the grade and tonnage so that they can understate the potential recoveries and get better deals or make better deals or agreements with the regulators. They can certainly overstate extraction costs so that they pay less because their profits are lower. And this is of course very difficult for the regulator in terms of strategic planning and fiscal planning. The lack of knowledge on information, on geological information, makes it very difficult to plan strategies for any country. Assuming the first graph that I've said, we know that the demand for graphite is going to increase. If a country wants to ensure that they ride the wave of the green energy transition, it will be very important for them to know if they have those resources or where those resources are if they don't have them and how they can get them. So the lack of geological information is not just a problem in terms of investors coming and knowing more about what you have and being able to pull a fast one. It's also the ability of the regulator to actually plan properly for their own needs. Of course, it does create an uneven bargaining table. And the goal is not just that it's an uneven bargaining table in terms of getting the revenue. It's in terms of environmental pollution. It's in terms of rehabilitation. It's in terms of social responsibility for host communities. So these information asymmetries are quite are one of the biggest factors in terms of, certainly in terms of financial flows from the industry. And I mean, I'm going to just, when you think about the information asymmetries, you think about the players who holds this information. Multinationals hold this information, so they are not from the host country where production is taking place. They will be subject to different tax jurisdictions. And most often than not, they will have more information about those jurisdictions and their impact on their business activities than the host country. So in terms of the investors, they would need to know, or they will know what the rules are in the host countries in terms of the tax regime, what the rules are in the home countries in terms of what they can bring in from their activities from abroad, and then agreements between the home and host countries. So what are the tax treaties that exist between them? And the behavioral incentives for investors is to find a means in which they are able to retain the maximum revenue by playing around with this understanding. A recent report by United Nations Center of Trade and Development showed that illicit financial flows, so essentially money stealing from Africa, amounts to about 88.6 billion a year. And 40 billion of this is actually linked to extractive commodity under invoicing. And this is because the multinationals and the players that are involved have a lot of access to market information. Not only that, they have a lot of access, have a lot of access to information to facilitate moving of funds under the radar. And I mean, under invoicing basically means that the companies declare lower values of exports than the value of import. So whatever they take out in Namibia, they will say it's $2. When they go to wherever, the UK, they will say it's $5. And in this way, Namibia has actually lost out on revenue. And under-invoicing is is quite prominent in the high-value, low-tonnage minerals such as gold and diamonds. So information asymmetries are is one of the reasons why this can take place, because there is such an imbalance in terms of know-how. Of course, regulators can diversify this risk and can try to invest more in their geological capacities. But the market concentration of multinationals is such a significance that it can the influence is so great that the risk cannot be completely diversified away. And certainly the vertical integration of multinational allows for influence of prices over the key parts of the value chain. And this is quite a huge factor, to a huge characteristic for regulators and mineral dependent countries to deal with. And last but not least is the fact that mineral resources are actually finite. And they are not, technically speaking, they are not finite in terms of how much is on Earth, but it's in terms of ability to be extracted for use. So at any specific point in time, there is a specific reserve. So there's a specific amount that is able to be extracted. And any extraction today means less potential for extraction later, later. Of course, this is why investment in exploration is very important. It's to replenish the depleting reserves, which is the economic part or economically extractable part of the mineral resource. So investments will be driven by the economic part of this resource, but these economics are not fixed. They are very much dynamic. What determines or what makes a deposit economic is very dynamic. And there are different modifying factors that go into deciding the economic nature of a discovery. And this goes into mining, the mining techniques that are used, the metallurgical properties, certainly technology. Technology can move in such a way that non-economic deposits can now be extracted, and so therefore they are now economic. Social and environmental considerations. And for the regulators, certainly the legal and political environment. And the legal environment is in terms of the legality of using certain commodities. For example, asbestos. Asbestos was widely used in roofing until it became illegal to use it in roofing due to its carcinogenic impacts. And so all the asbestos deposits, it's technically feasible to remove them, but it's no longer needed because the regulations in place do not make it economic. There is no demand for it. On a political front, certainly political unrests, unstable fiscal regimes. So when investors do not know what terms they will expect from year to year, day to day, from change in political parties or change in government, that makes some deposits actually not feasible to extract. And so they are no longer economic. When you look at a single deposit, the life of that project is actually not dependent on how much is in the ground, so much as it depends on, yes, how much you take out, how much, what you do to replace it, and what the modifying factors are around that deposit. So I've come to the end of my presentation, and I've just touched on the finite nature of the mineral resources, the information asymmetries that allow for illicit financial flows in the industry, the complex configuration and the location specificity of mineral resources and mineral deposits, which should essentially allow parts of location specificity should allow host countries to have some sort of advantage in terms of what they can recoup from revenue they can recoup from projects, but the complex configurations which make recouping of a revenue quite difficult. We talked about the need to put in quite a lot of investment to just to get to the high returns that everybody is looking for. And we've looked at the prevalent uncertainties and the risks that are inherent in the industry, which makes it difficult to determine how much is actually going to be recouped, or how much profit one can get from any existing deposit. And I will end my talk there. Thank you very much. Thank you, Vanessa.
Thank you very much, Mary Barton, for your presentation. I believe that everybody that is here was able to get a thing or two or everything, depending on your level of understanding. This is the moment that we're going to have for questions, commentary. We can also have a brief discussion. So if you have any question, you can go ahead and raise your hand or drop the question on the chat box. Okay, we're going to start with Apsai Vatuva.
Thank you, Vanessa, for the opportunity to engage. And let me congratulate Ms. Barton for the wonderful discussion on the mining industry. It's really a lot to take in, and it has given a lot of insights on what is happening in the mining industry. Mine is really on the renegotiation issues. Maybe, I don't know. We, especially in Namibia, we have the Chamber of Mines that is really very active and is up to standard, and it's really putting the mines and mining operators in order with its mining framework and so forth. But of recent discussions and so forth, especially some newspaper articles, is stating, for instance, in terms of revenues, that, for instance, if the mining industry contributes about 13% to the GDP, and 9 of those 13% is coming from the diamond industry, the diamond mining. I think for me, the diamond has always been our bread and butter, and as for it to contribute that much to the national coffers, I think it's really there to say that is our strategic mineral. I don't know now in terms of negotiations what is happening there, that it is contributing 9% of the which means then the other 5% of or so is coming from the base metals and so forth. I don't know if maybe Ms. Barton could maybe discuss on that, on what is going on, what is going on there, and also that 88.6 billions of US dollars are coming are going out of Africa unnoticed. This illicit flow is a very big concern. I don't know what is the underlying factors there, but I think our people that are, because as I understand, most of the companies that are running the industries are multinational corporations, not African, so to say, but I think it is mostly the African people's persons that are employed there, or are they the ones that are rigging the results, or what is happening there? Or is it that maybe the people that are working for these companies are maybe not at how do I say, decision-making points, or why would one try to record low revenue? Then it is really then the actual revenue, if I mean that has some ethical issues. Is it that universities are not training ethical employees, or what is happening there? If there is any understanding on how the 88.6 billion is going on. Otherwise, it has been a very fruitful discussions, and I hope students, especially students, have learned a thing or two on how to position themselves along the value chains of the mining industries, and much of it is really that the government cannot maybe own mines or something like that, but it is all our people that are working there. Maybe it's something to think about on our own, how do I say, abilities to run. Are we really not able to, or what is happening? I think that would be all from me. Thank you very much. Back to you, Ms. Chair.
All right, thank you very much, Dr. Vatuva. Ms. Mary, I believe that you heard the two questions, so back to you.
I didn't quite get to the question about the diamonds and the, I mean, renegotiation. I don't know if Doctor was asking regarding renegotiation of terms where companies want to have lower rates in times when commodity prices are sunk. I mean, if that's the question, that's the normal reality. And if you see the tax regime in Namibia, diamonds are quite heavily taxed compared to other commodities. That might account for part of why they dominate in terms of revenue contribution. But I think the quantity that comes out and the value of what comes out of Namibia is also quite high enough that that it supports, it gives that much contribution. For as much as we would want to push higher revenue recoupment or higher revenues from the mining industry, another point for I think regulators to look up is to diversify the economy actually. and not just look at mining, which is finite. So at some point we would have removed what is available in Namibia to be extracted. What do we do firstly with the revenue that we've gained from this finite deposit so that we can make it go a longer way? But what are we doing to other industries in terms of soliciting or pushing growth in other industries to make sure that we have some sort of leveled growth, economic growth all over? What you will see in terms of Namibian history and dependence on mineral revenue, we've always followed our revenue and our planning and our debt sustainability has always followed revenue from mining. And this is not sustainable in the long run, which is why we are where we are right now with low Fitch ratings, because we've been relying on unstable income to do a lot of our fiscal planning. So we assume, we know that diamonds will give us this much. This is how much revenue we'll have, and we plan and spend a lot of money on that. And not only do we spend that money in non-investment ways, we consume that money, and we spend it on normal social growth and social development avenues. And so that's one of the problems. In terms of illicit financial flows, it's obviously a big problem. Again, information asymmetries. If your revenue collecting agency cannot, or at least your, for lack of a better word, your geological regulators cannot track to at some point give you a financial flow of your deposits, there's no way they can actually track revenue and what should be due to them. They'll need to trust the operator to say, this is how much we've taken out, this is how much it's worth. So there is a lack of information available in the open market for that kind of information. It's not available in the open market, and maybe also not available to the geological regulators or the Ministry of Mines and Energy. But there's also a lack of capacity. Are we equipped to do that kind of accounting in terms of keeping a finger on the pulse of our inventories and what's going in and out? Yeah. And just to mention that 88 billion is per year. It's a yearly outflow. So it's quite significant.
Thank you very much, Ms. Mary. I believe that both questions were answered clearly. There is another question on the chat room, which I'm going to read. Yes, the question was posed by Solomon Kasirye. He's asking, he said, I would like your view on the CSR, which stands for Corporate Social Responsibility. To what extent should companies cater to development needs of the community they work in? And also when does this encroach on the government's duty?
I don't know if you want my personal view or the textbook.
Yes, your personal view.
Textbook view. I think personally that we do need to hold corporates responsible, and I think looking at the inability for tax regime to capture maximum benefits, and that's the reality, is that sometimes the tax regime is not capturing maximum benefits from and that's not to say it's all the benefits, it's the benefits that should be due to them under the existing fiscal regime. We've seen that there are illicit financial flows, and therefore even existing fiscal regimes are unable to capture what is due, what is agreed upon by the partners. There is a sense of corporates should be doing more for the host communities where they are from. Of course, there is also a sense of overstepping boundaries where they would be taking over the functions of the government. And I think it's for citizens and certainly for the host communities to determine how they are holding their governments accountable. And corporate social responsibility, obviously, it's more a corporate response. So it's a voluntary response from the company itself to say, this is what we recognize. We are part of this community. We are you and you are us, and therefore we are obliged to put in what we can for you. And certainly there is a push from the communities themselves to say, you owe us because of this. I think in my personal view, some of it is warranted, but some of it is probably misplaced responsibility, in that we should be holding our governments who we've elected a little bit more accountable to ensuring that our societal needs are met.
All right, thank you. I hope the question was answered, because I do not see the person in the room anymore that asked. So we're going to move on to the next question, which was also sent to the chat room. It was sent by Kanahu Haingura. There are two questions, actually. Just bear with me because they're a little bit long. So the first one is, according to the UNCTAD, which you alluded in the presentation, says that about more than 88 billion, not real sure about the exact value you stated, is lost from Africa. So this is a question similar to the one that was posed by Dr. Batuba. My question is, do you have any idea how much Namibia is losing from illicit means in the mining industry? And what are the measures in place to solve this problem or prevent it from happening? So we can answer this first question, and then I'm gonna pose the second one.
I have no idea about Namibian quantities. I was in no way involved in that research, just to state. But no, what they've done was they did quite a number of studies on African countries. I know Zambia was one of them, South Africa was one of them, and there are individual reports available to look at the details of the illicit financial flows. Those are available. I've not seen anything on Namibia, but certainly in terms of EPZ status, and there is, conceptually speaking, theoretically speaking, there is a point to be made about loss of revenue through EPZ allocation, but it's a conceptual thing, and for as long as we do not have the numbers to look into it, they're not publicly available, we cannot definitively give anything. I know that UNCTAD report definitely speaks about the needs for transparency in information, so that civil societies and citizens are able to peruse and look through these and make some sort of informed, to have some sort of informed mindset. So certainly there is a need for some of this information to be made public, so that it can be perused and looked through in detail, but no numbers.
Okay, thank you. The second question is, how do you explain our Namibian mining tax holiday, its benefit to the Namibia economy, and what are the measures in place so that some companies would not misuse it or ensure it carries its intended purposes.
Question?
I repeat it.
Can you hear me?
I can hear you. Should I repeat the question?
Okay, can you repeat the question? I didn't hear you. I'm going to put off my video because I think my internet has just started dropping, unfortunately. I'm going to remove my video.
Okay.
You can still hear me, right?
Yes, I can hear you. I hope you can hear me too.
Yes.
Okay, so the question was, how do you explain our Namibian mining tax holiday, and what are its benefits to the Namibian economy, and what are the measures in place so that some companies would not misuse or ensure it carries its intended purposes?
I think in general, the tax system is, maybe they would skim through. I'm actually not very familiar to how they would track underreporting of production, for example, and whatnot. But tax holidays, Namibia does not actually, I'm not certain Namibia has tax holidays. I think EPZ was the worst of them all. So I'm not sure I can answer that question really. I mean, it in terms of making sure that, okay, overall, tax incentives are the worst way for any regime to go. So they are an absolute no-no. Anything that removes your tax base. There is a case to be made for tax, for pushing back tax payments. So not a tax holiday in that they don't pay the payment, but rather a tax delay, so that they can be a bit more stable and repay back. But certainly overall in resources, the idea is that tax holidays are an absolute no-no.
Okay, thank you. If any of the participants also has a comment regarding any of the questions, you're more than welcome to do so. Any comments, any suggestions, any contributions? Okay, on that note, we are at the end of our meeting since we don't have any more questions, any suggestions. So on behalf of the University of Namibia SCG student chapter that was recently established just this year around June, so June 2020, we are still new and we are growing well. So we want to thank you, everyone that was able to come to attend this forum and support in every sort of way. We are very appreciative. Thank you, Ms. Mary Barton, for the presentation. I myself was able to get something from it as a student, and I believe my fellow students also got something from it. And we appreciate all the support that we are getting. I have been receiving a lot of messages on this platform privately, and I'd like to thank everybody in general for the support. And on that note, we're going to end our meeting. Just to let everybody know that we still have a few more talks in line. The next one is planned to be on the 21st of October, but in the same way that you were able to get to register for this presentation, you're also going to reach to the other presentations that are still coming. They're also very interesting topics, just like this one. So thank you very much once again, and we are going to adjourn our meeting, and have a good rest of your day, everyone.